Tom and Jerry were two friends who lived in a small town. And when they received their first salary, Jerry invested his money in a mutual fund while Tom kept his saving in a jar at home. Over time, Jerry's investment grew steadily thanks to the diversification and professional management of the mutual fund. Tom, on the other hand, watched his savings stagnate, fearing market risk. Years later, they met and compared their financial situation. Jerry's patience and willingness to invest paid off, giving him enough for a down payment on a home. Tom, despite having saved diligently, realized he had missed out on a potential growth. Moral of the story: do not fear to invest because investing wisely can unlock opportunities that simple saving might miss. I wish I have started investing early. Every investor must have thought of this at least once in his or her life. But do not worry here because the greatest investor of all time, Mr. Warren Buffett, has got majority of his wealth after the age of 60. So even if you have started late, do not worry. Just start and invest for a very long period of time. Because the more time you will invest, the better your investment will get. Just start, either early or late. Just start and invest for a very, very long time. Ever wondered why smart people make dumb financial decisions? It's not just about numbers, it's about psychology. So let's talk about behavioral finance and break it down in 60 seconds. First, meet loss aversion. People hate losing more than they love winning. This leads to holding on to losing investments too long just to avoid feeling the pain of loss. Next up, herding behavior. People tend to follow the crowd. Ever bought a stock just because everyone else is? Then there is overconfidence. Investors often believe they can beat the market until they can't. This leads to risky moves and losses. And finally, anchoring. This happens when we fixate on a past price or number and let it shape our decision, even if it is irrelevant. So what is the takeaway? Understand these biases, it will help you make smarter financial decisions. John, an amateur investor, sat at his desk scanning news reports about the central bank's decision to implement quantitative easing. He's heard the term before but never fully understood it. In simple terms, QE is when the central bank buys government bonds to pump money into the economy, lowering interest rates to encourage growth. John wondered, will inflation rise? Will the dollar weaken? He knew this could affect his investment. QE could push investors into riskier assets like stocks, raising prices. But it might also signal inflation, which could hurt other sectors like real estate. Tech stock might benefit from QE, but John realized it is a balancing act. With a mix of excitement and uncertainty, John decided to hold steady and keep learning. Understanding QE was just the start of his investment journey. Mutual funds are good for investing. But does that mean all mutual funds are good for investing? No. Then how to know whether a fund is good or not? You can know that by checking how much expense ratio do that fund have. This is a fees these funds charge for actively managing your portfolio. And if this expense ratio is high, then over time it can eat your returns, even if they are able to beat the market or not. And that is why when I say mutual funds are good, I talk about index funds. These are the type of mutual funds which try to track the market rather than trying to beat it. So no active management is needed, and hence their expense ratio is low. Also, because they are trying to track the market, so in a long term, they give you good returns. So if you want to create wealth over a period of let's say 10 to 20 years, then you should look into low cost index funds.